What's up, everybody? Eric here. Welcome back to the Outlier podcast, where we talk about all things extraordinary. I'm here with David Hunter yet again for another conversation. I was actually looking back at our conversations, and I think we started connecting in the spring of 22. So it's been about 2 years. I wanted to wish you a happy anniversary. It's been great for me. I hope it's been great for you.
Yeah, it's been great, Eric. Great to know you.
So we were literally just talking off air for a couple seconds just about how interesting things are. And I feel like every time we connect, you and I maintain like a quarterly cadence, give or take, and there's always stuff that pops up. So I honestly would love to just start right there with you. As you think about the markets today and as you think about the economy, the world today, specifically over the last week or so, like what's jumping out at you?
Yeah, it's definitely been a period where the markets are nervous and given lots of reasons to be nervous. It started out weeks ago with inflation kind of raising its ugly head, and everybody was kind of expecting inflation to be trending further down from here, from where it was when it came into this year. And instead, it went the other way for, the last 2 or 3 months. Excuse me. And so, you had the bond market back up. You had investors get nervous that the Fed's not going to cut. And it started out with, well, it's not 6 cuts, maybe it's 3, and then it's down to 2. Now people are worried that we're not going to get cuts this year. So you get all of that, and then on top of that, we get what's going on in the Middle East, and investors are certainly nervous. What's interesting is that the S&P hasn't even backed up 4%. It's got maybe 3.8% from the all-time highs. And that's with all this distress and all, investors very nervous. As I say, yes, you had a big move from last October, almost 30% in, I think 31% in the NASDAQ and almost 30 in the S&P and 30% in the Russell. You had that run, and people got more bullish. Obviously, the tape moved up, and investors got more bullish. But what I've noticed is that they're bullish without conviction, which means when you get a rollover like we've had this last month, first it started out kind of flat, and now it's rolled over this week with what's going on in Israel. People run for the hills quickly. They turn tail very quickly. So yes, they got more bullish with the tape, and that's kind of how it works, but they aren't there with conviction. So it doesn't take much for them to lose that bullishness and go back the other way. That's a good thing from a standpoint of my outlook, I think, which is bullish, because I think that just builds that wall of worry back up very quickly. So you don't need 10 and 15% corrections. You get what you would normally get with a 10% correction. You get with something that's less than half of that. So I think we have, lots of things to worry about out there, but I don't think any of it's going to interrupt the melt up.
Interesting. So I saw a comment literally from Powell's Q&A in Washington today. Powell had said, this is a quote from him. It says, quote, "The recent data have clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence." Obviously, this has to do with inflation and their disposition towards how they want to manage inflation. To me, it seemed like the market got a bit of ahead of itself, and you could see that written in even across the bond market, starting to price in cuts. And then I think the recent bit of data ingestion has shocked that a little bit. What are your thoughts on that?
Yeah, I agree with that. Certainly, the market got way ahead of itself with expecting 6 cuts, and then it, as I said, it tapered down to 3 and then 2, and now with Powell's comments, there are people wondering if we're going to get a cut this year. He's not coming out and saying we can't have a cut in June. He's not coming out and saying we can't have cuts this year, but he's basically, and I've claimed this over and over, defended him over and over, and said he's being as transparent as he can be. Take him at his word. He's not trying to fool you. He's not trying to, play games with you like Greenspan used to do, where you had to read between the lines. what he says is what he thinks at the time, and what he's thinking right now is what I think the street is thinking, which is, gee, we've had 3 months in a row where inflation ticked up, and we were expecting it to tick down. We've got an economy that continues to show resilience. What's the rush? We don't need to cut right away and then create a problem for ourselves down the road by being premature in that cut. So I think he's basically echoing what the street already expected or saw. And I think you see that in the market this afternoon, because his comments in other times might have been taken bearishly and you might have had the market down 2%. Instead, the market's up. It sold off on his comments initially, not all that far, but it did sell off. And now it's turned right around, and we're not quite at the highs for the day, but we're up there. And I personally think we may have seen what we're going to see in a correction. It could go, it could reverse this week and go a little lower, but I'm not looking for any big correction here. I think, as I said, we rebuilt the wall of worry with not a lot of sell off.
Now, out of curiosity, when I look at markets, I tend to think that they're pretty smart. There's a lot of people that interact with markets with a lot of good data. And the fact that we got, again, seemingly pretty far ahead of ourselves, it surprises me a little bit. Just, I'm wondering what's the function from a market perspective that would lead them to front run the move quite that much? Because when I've been looking at this from a layperson's perspective, it's been very clear the way Powell at least has been synthesizing the data, and I've been kind of not quite mimicking him, but thinking of it in the same way. Like, you see the data released and then you make an assumption. But it seemed like the market had been front running that data so much, and it seemed like they were just like pretty far off. I don't understand why they would do that. Like, what's the built-in incentive for them to do that?
Yeah, it's interesting because I think when you refer to the market, I think you're referring to the professional investment community, basically, right? You're thinking in
Yeah,
terms
yeah.
of those
Market
that
participants
analyze
writ
the
large.
numbers and the supposedly smart money.
Yeah.
When I refer to the market, I refer to the market in the aggregate, which includes all investors, whoever's in there. It's what the market is saying. So not what the smart investor is saying or the street analyst is saying. It's what the market's saying. And those are two different things, because as you know, the so-called smart money fought this rally all the way up from 3,500 a year and a half ago. When it was 3,500 on the S&P, it didn't get bullish until we were up over 4,800, basically. And so, they may be smart money, but they got it wrong. Meanwhile, the market itself, for whatever reason, saw a reason for it to keep going. And, as you know, I basically have echoed the market in terms of, anticipated what the market was doing in terms of being bullish when most people were bearish and saying we were going to have a melt up. So what I think the market is anticipating and seeing, and what I'm seeing, is that ultimately, no matter whether it's this month, next month, 2 months ago, 4 months ahead, we're nearing the end of a tightening cycle. That tightening cycle has been going on for 2 years. That's a big deal. And ultimately, in spite of the numbers that may say, we're going to have no landing or a soft landing or no recession, I think underneath the surface, there are lots of signs that we are heading for a recession. And as you know, I think it's going to be a lot more than a recession, global bust. But in the meantime, what you get is your cake and eat it too, because the economy is operating at a pretty low recovery level. It's not roaring hot. Inflation has been trending down, and the last few months notwithstanding. And what you've got is inflation that was 9% now down at 3%, essentially, and depending on the measure you want to use. And ultimately, in my opinion, and I think in the market's opinion, still trending down. It just isn't going to be a straight line. So I think that's what the market's picking up. And as you know, I look at what I call cross markets. I look at a lot of things underneath the surface in terms of individual companies and sectors, et cetera. And they're saying the same thing, which is we're about to have things that have been out of favor come into favor. So copper producers, which have been out of favor for quite some time, are now starting. The charts look great. They're moving to certainly 12-month highs and beyond. And they look like they've got 50-75% upside in them. That doesn't happen in a situation that fits what this so-called smart money thinks we're heading for, which is higher for longer, an economy that needs interest rate cuts but isn't going to get them, inflation that's trending up, not down. That's not what the market's telling us. So I think I learned long ago, having done this for 50 years, to pay attention to the market when it disagrees with that so-called smart money, and or the informed professional investor, or analyst. They can get it right sometimes, but they don't always. And I think the market in the aggregate, it's the law of large numbers. The market in the aggregate generally is a better predictor of the future than any individual, no matter how smart we are.
Yeah, that makes a lot of sense. And actually, I'd like to double click on that from a structural standpoint to understand your perspective a little bit better. Because when I think about the market, quote unquote, I typically think about players that have enough capital to make a meaningful movement in price. So to your point, I typically would exonerate retail out of there because there's very few retail traders that could even put a dent in anything. Now, going back to your point on this idea of smart money versus the market, how do you differentiate between those two in your worldview? Because obviously, if we go from 3,500 to 5,260 in the S&P, there has to be big money that moves that. It doesn't just go up there from like retail traders buying. So who are the people driving that price appreciation in your world?
Yeah, this is not a kind of an either or of either retail or professionals, and it's not. Investors aren't monolithic, so there are very bearish people that are considered some of the best investors out there. There are very bullish people who might be considered some of the top investors out there, and there are people in between. So again, I'm not trying to pick and choose which investors have this right. It's the fact that the market is a discounting mechanism, and when you put all investors in there together, they're discounting what in the aggregate they see, and that way it's not about analyzing what kind of economy are we in, or what. It's basically understanding the market predicts the future. It is, and again, what's tricky about that is sometimes the market gets it wrong, so you have to kind of decide where you are in that. But generally, it's the law of large numbers. It's the market in the aggregate. All investors, retail, institutional, hedge funds, insurance company, all of them, all in there together. When you put it all together, is a good, pretty good predictor of the future. As I used to take Powell to task, when he was, and I think he's still doing it to some extent, but when he was, really, he and his minions on the FOMC were spending so much time trying to jawbone the market down and deciding where the market should go. I go, think about what he's doing. He's taking out of his basket of indicators the stock market, which in my opinion is the best leading indicator. It is the most accurate predictor of the future. And by forcing it to where he wants it to go, or thinking he can force it to go somewhere, he's removed it as an indicator, and he's deciding he knows best where it should be, right? I don't know if that's confusing, but it to me, the stock market is one of our best, if not the best, leading indicator. Again, it's not foolproof. It sometimes gets things very wrong, but in general, it is a discounting mechanism that tells you what's coming. And so those that are spending time trying to figure out what the economy is doing, or what interest rates are going to do, or what have you, are probably not going to be as accurate as that aggregate stock market in terms of what the future is.
I see. So yeah, I actually think then in general, you and I probably have a pretty similar view on what we would consider the market. Now, when you think the market gets so far ahead of itself, meaning in terms of discounting and including the prospects for a cut, what do you think drives that? Is it people just trying to get in at the very precipice of a move to maximize the move? Do you think that there's other imperatives that drive the behavior? I'm just curious from like a broad perspective, what would get a lot of people to pile into something, because when I look at it from my point of view as a trader, I look at it as, and this has been my entire point of view the whole time, like actually very similar to Powell, like until I see stuff that makes me think differently about what rates might do, meaning I'm typically looking at the bond markets, I don't really look too far beyond that. I'm just kind of seeing what's happening there. And the bond markets seemed for a while to be pricing in, like you were talking about, quite a few cuts this year, but then they've pared back. So do you think that they're just using different models, whatever the case is, that kind of project them forward and then we integrate new data? Or do you think there's a bit of mania that's built into this? And the reason why I'm asking this question is to differentiate for your kind of melt up scenario, if that's going to be more of a mania driven event.
Yeah, good question. I'll give you my take on the whole rate cutting thing and how we got there. People have speculated about why did they build in 6 cuts? There was no reason to build in 6 cuts, or how did they get there? And I think, and again, that's really bond investors, right? Not the stock market, but the bond investor, the fixed income investor was trying to figure out what the Fed was going to do. And, you look at the futures market, they're basically predicting 6 cuts for this year. I think they kind of took the ball and ran with it in terms of the whole scenario that the economy is weakening, inflation's coming down faster than the Fed thought, and that we were going to be in a sweet spot where you'd have very low growth, if not negative, at the same time that you almost were at or even could possibly get below the 2% target on inflation. So, when we entered this year, I think that's where the mindset was, and that's rates pretty much bottomed out there. On the bond market was, they anticipated, as did I, that the economy was probably going to be weaker going forward this year, and that inflation was going to continue to trend towards the target, if not get there. And frankly, that the Fed was behind the curve because short rates were still up at 5%. Fed fund rate was over 5%, and that if inflation's down at 2, you've got a pretty hefty real rate there, which is restrictive. And if the economy is softening and it's restrictive, you got a problem, and it means you got to cut several times to get down to a level where you're not going to create a hard landing. So that's where I think the mindset was, and they came into this year with that mindset. And then, January, February data kind of caused them to question some of that mindset and take some of those cuts off the table. And then I think March was just a real surprise to them. Only 0.1% tick up, uptick from expectations, but I think they were thinking the whole housing, real estate, rental part of the CPI is overstating house prices and inflation in the real estate sector. And so we're going to get at some point here, and we think it could be March, we're going to get that finally factored in, and we're going to get a better than expected number. And instead, we got a worse than expected number, and it just caused a really quick readjustment to questioning whether we were going to have the 3 cuts that they had thought, or whether it's going to be 2. And now, like I said, just in the last couple of weeks, the real question becomes, is it going to be 1 or none? And I personally don't play that game. I'm not worried about my call. Does not depend on how many cuts the Fed does, but it does somewhat depend on what the bond market does. And I'm still a believer that what we're looking at here is a consolidation, although it went farther than I expected or thought it would need to. Consolidation of that 120 basis point drop in the 10-year, in the fourth quarter. We went from 5% to 380. Now we're back up at 465, and it was close to 470 today. That's a steeper backup than I would have expected, but it's still, I think, going to prove to be a consolidation of that run, and we'll just roll back over. And I still think we're going to hit 3%, in coming months. So, but that remains to be seen. That's my forecast, not reality at this point.
Now, you brought up something actually that I was taking a look at, which was the housing market. And I saw that we had some housing start numbers come out today. Those were forecasted at 1.485 million, and they came in at 1.321. And then building permits, they were forecasted at 1.51. Those came in at 1.458. So both starts and permits contracted a little bit. Does that mean anything to you?
A little bit. I would say coming into the spring with the interest rate forecast that I had and with what the street was expecting until this last few weeks, I thought we'd probably have a spring bounce in housing that was pretty good. It's not, we wouldn't go back to the highs in either activity or prices, but that we'd have a pretty good spring bounce, and that might actually feed into a little bit of a worry about, the economy reaccelerating, inflation reaccelerating. What we've actually gotten, I think, is from a standpoint of those that want strong housing, I think this backup in rates in the last few weeks really puts a damper on that spring bounce. And so I think the numbers today are showing that you're still not just rolling over and going south, but you're starting to put a crimp in any kind of housing bounce. And ultimately, I think we are heading for a recession, and housing is going to get hit hard. So, any bounce here was going to be temporary anyway. You may still get something as you move towards the middle of the year if rates come back down, but I just think we're running out of time on housing. I think we peaked in housing 2 years ago or 18 months ago, and I think most of what's ahead is downside, not upside.
Do you differentiate at all between residential and commercial? Obviously, we're saying housing, so I would think towards, single homes,
Yeah,
maybe rent, and yeah.
Yeah, for sure. Housing is, I'm talking specifically about that. The commercial real estate, obviously the office buildings, I made the circuit, I think a week ago, where there was a building in St. Louis that, sold for like, a big skyscraper, looked fairly modern, and yet it sold for like $3 million. And, a couple of years ago was valued at, 40-50 million dollars, I think. So we are seeing an adjustment in commercial real estate. And there's a lot more of that to come. The banks are, trying to kick the can down the road where they can, and yet in other places where they've got bad debts, they're having to eat it and rationalize it to the real prices. But there's definitely commercials taking on the chin sooner than housing is, but I would say housing is coming. That once we get into that global bust, probably next year mostly, that you will see. I wouldn't be surprised, and again, every market's local in housing, but I wouldn't be surprised if across the board we saw something like on the average a 30% or more decline in home prices from the peak. And some places have already started that. I think out west in Phoenix and Dallas. I'm not sure about Dallas, but Phoenix, I think, has been hit pretty hard. In some of those areas, you're already seeing supply back up. But across the board in the country, I think that's still ahead of us.
I see. Two questions on that. The first one, just an add on. I saw, similar to what you saw in St. Louis, I saw a very similar story in San Francisco, and I think it was an apartment building that ended up selling very, very cheap compared to where it was very recently. So, just another indicator of that. But going back to just housing from a broader perspective, part of me looks at it as the in office scenario for workers in general has changed a lot. And we still have a lot of office buildings. I don't think that they would all go away, but what are your thoughts on the future of office buildings in general? Do you think they're going to start getting repurposed into other style buildings, or do you think that that's going to be just a fallen part of the market in the not so distant future? It's kind of a niche question, but I find that one to be interesting because when I look at different kinds of office building inventory, it's not contracting. So there are a lot of people trying to do something with this inventory. What I'm unsure of is what's the subsequent impact on how they choose to handle the inventory.
Yeah, I think we are seeing already some repurposing, and it's tricky, I guess. I'm not in that field, but I know that some buildings are easier to remake into housing. Some of the downtown areas where New York City or somewhere like that, where there's a real need for housing, it could bring some of the prices down for apartments and things. They're trying to do it, and it depends on the building, I think, as to whether it's easily converted or how expensive it's going to be to convert. You're seeing that around the country, I think, to some extent, but it's kind of case by case, building by building, whether it makes sense. I think the malls are trying to repurpose to some extent because they've lost anchors and they've lost retail stores. So I saw something recently where one mall was converting some of the mall to housing so that
Oh,
they'd have their
interesting.
retail right next door to their housing. But so I think you will definitely see it's not just going to die. There'll be new uses. Obviously, industrial commercial is up and coming. I mean, there's as we reshore and things, there are parts of the real estate market that will actually be investable and moving up, not down. But it's the commercial, as you say, where we in the pandemic, so many people learned they could work from home and have been reluctant to go back. That a lot of that office space in the big cities is excess now. So I know there are companies trying to bring their employees back, and some have been successful doing it, and others not as much. Um, it's a tough one. It's people really have learned, and certainly technology supported them in terms of being able to be productive at home and not have to go through 2-hour commutes. And obviously we're dealing with in some of these inner cities now more problems, whether it be from the migrants, whether it be from our being less willing to keep people in jail. Crimes worse than it's ever been in some of these big cities. So another reason for people to work remotely. So I think that again, the trend is there. Some of it will ebb and flow back in the other direction, I think. So it's kind of work in progress.
It's interesting to me because from a trading standpoint, whenever I see stuff like this, I can't help but look for opportunities. And to me, that does seem like a budding opportunity. However, I do invest in commercial real estate with some partners, and the rate environment right now actually kind of puts a damper on the party. Not any of us are overly excited to be the ones to try the fun stuff right now. So it's an interesting perspective. If
Plus, you've
yeah,
got an awful lot of the refinancing is in this window of the next year or two, I think. And unless rates cooperate and come down, that's going to probably create another wave of problems for real estate. So, and for the banks. So it's probably early. I'd say the opportunities there might still be a couple of years off, a year and a half off. So it's tempting when you see the problem and you see that, you see like that sale I've mentioned. But I have a feeling that, stepping in here, you might be catching a falling knife for a little while yet.
Yeah, that's honestly, at least from my world, what most of us are looking at. But we don't really do apartment, or we don't really do office buildings. So it's a little bit of a different market. That's one thing I definitely have developed an appreciation for as I've gotten more involved in the commercial real estate space, is just how bifurcated. There's just so many niches within it. It's almost, yeah, that part is a little more pronounced than I even would have imagined. But stepping away from real estate, going back to markets, I've noticed a few interesting themes specifically relating to the sectors, where over the past 3 months, we're kind of getting a bit of a change in vanguard. Where if I look over the past 6 months, I see mostly tech leading the pack. So commercial, communication services, information technology, kind of standard fare. But then if I go into a month, I see comm services still up top, but then I'm also seeing energy, industrials, utilities, materials, a lot of these sectors starting to bubble up to the top. Two questions. One, is that similar to what you're seeing? And two, do you think that we're going through a bit of a sector rotation, recommitting of capital here? Or do you just think that these are some of the things that have been beaten down so far that they're being propped up a little bit, but then capital might rotate right back into tech or something like that?
Yeah, I think it's all of the above. We really have, when you step back and look, particularly at the S&P, but also the other markets, we really have had 6 or 7 weeks here of consolidation, where it kind of topped out back in, I don't know, early March, late February, early March, and we've gone sideways. And again, this week or in the last week, rolled over some, but basically still in a kind of a high level consolidation. So some of what you saw was the market wasn't giving up a lot, but you were rotating. So you did have some of that sector rotation, and some of that sector rotation was back into the defensive areas that had not been performing, in the fourth quarter into the early part of the first quarter, because they were defensive and the market was taking off. So utilities, consumer staples, healthcare, some of those areas had kind of come down or were underperforming. And with the consolidation, people are running back to some of those safer havens where they're not so dependent on say, the market moving up, or where they saw that they had come down and saw them as value again. Um, but at the same time, we've had, as I mentioned, copper producers, but we've had a lot of the kind of the industrial side of the economy, the old economy, the value industrial side of the economy starting to pick up. So I noticed it in steel. I noticed it in, the copper companies. You can see it in, I mean, XLI, which is the industrial ETF, is through the roof. I mean, if people haven't looked at it, if people bought into that Magnificent Seven um, narrative and didn't really look at these other things, I think they'd be shocked to see where some of these stocks have gone. They look like Nvidia. They don't look like stocks that were asleep. I mean, PACCAR, which is truck manufacturer, and Eaton, which is involved in trucks. You look at some of these heavy industrial companies, Parker Hannifin and Ingersoll Rand. Um, Take a look at them. They're straight up. They've been great stocks for many months. And I was pushing back on that long ago, as you know, where people would say it's not really a good quality rally. It's all the Magnificent Seven. It's a very narrow. That's not good. I go, look at the housing and home builders. Look at XLI. Look at there's a lot of groups that have actually participated quite well in the last 6 months. And so, and by the way, in this last, say, 6 or 7 weeks, what also has happened is that the semiconductors in particular, but tech in general, um, they started rolling over and consolidating their big gains. So semis, which have had such a great run for the last 18 months, led by NVIDIA, but certainly Micron's done well, and all the capital equipment companies and semis, the Lam Researches and the AMATs and the KLA Instruments, those stocks have basically been high level consolidations of late. And so I think it looks to me like they're about to turn up again. So we've had a lot of what we've had in this last month or 6 weeks has just been kind of correcting overboughts, consolidating the gains, and getting positioned for another run. And I think the next run, and I've been consistent about this all along, I think we're going to see the market continue to broaden out. So it's not either or. It's not, gee, well, tech had their run, let's go somewhere else. No, you can still have a big run in semis from here, and from a lot of tech from here, but also be in some of the old industrial areas like copper producers and aluminum producers and steel, and some of those areas I think are going to do very well. And then you're also seeing, which may seem surprising since interest rates have backed up, but financials are starting to look, they had come alive and then kind of consolidated recently, and they look like they're poised to move up again. So, the broker dealers look great to me, particularly, I can't name names, but, a popular retail broker that has been out of favor for quite some time is starting to look very good on the charts. So I think there's going to be just ahead, not very far ahead here, a broadening of market and a resuming of the rally, and probably getting steeper as we go.
So specifically for the banks, I find that perspective really interesting because a lot of what we're seeing across the banks here, at least for the smaller banks, is actually, I would consider, more weakness. So what gets you interested in them at these levels?
Yeah, and I haven't looked at them this week, but I think what you're seeing is higher interest rates obviously hits them.
Yep.
Particularly the regionals with what happened, a year ago. So you got to kind of broaden, I think, and again, I don't have charts in front of me, but I think if you broaden your perspective and look at longer charts, you may see it in the context of a group that started to come alive and then got hit with the higher rates and has consolidated that run, but hasn't broken down. And I think they will go. I focus more on the broker dealers of late, and they just look very good to me.
I see. Yeah, that makes sense. Yeah, because I was just curious. I've been trading earnings specifically for the big banks. All S&P 500 banks as they're coming out, and they're all obviously having higher charge-offs. They're seeing lower interest-driven returns, but they're able to compensate it in other ways. But we know the smaller regional banks don't necessarily have the suite of tools to be able to pull it together quite as well. But that makes sense when you explain it that way.
And remember, I'm pretty biased by my view that rates are going to come down. And when I look at XLF, which is the ETF for the financial stocks, not just banks, but it looks very bullish to me. And I think it's, again, another prediction, that another market predicting or being predictive of the fact that I don't think rates are headed a lot higher here. We've got to get through this consolidation in the rates, but I think once we do, and I think it's soon, I think rates roll back over and head to new lows. So 380 on the 10-year was where we got to. Like I said, I wouldn't be surprised if we get to the low threes by this summer.
I see. Now, going back to metals, I was actually checking out aluminum because aluminum had been popping a little bit. What are your perspectives on metals in general? One of the questions I know everybody has for you typically is gold and silver, and kind of the relationship and comparison between those two. But I also would like to get into some of the more niche metals, like you were talking about. Copper, aluminum specifically top of mind for me, but happy to start with gold and silver.
Yeah, so I'll start with the base metals first, but I think there was, and I didn't follow closely, but they um, did something to take out supply from Russia. You know,
Yeah,
they're fooling around with
through some
that, and I
sanctions.
think
Yeah.
so. I think you saw some of the strength this week just simply off of that. But I think ultimately to carry on, you know, for that to have legs, I think what we're going to see here is that basically inventories are in good shape. I know in copper they're in really good shape. Um, China may be finally turning a corner a little bit, so you could have things, you know, where you get some contributions from their demand. Um, and you know, I think the base metals look very good. Copper is the one that I tend to favor in that group in terms of where it's clearest. But you know, like I said, the steels look like they're ready to run. Aluminum does, and you know, the one that's kind of lagged is the iron ore, but that'll come along if I'm right about steel. Um, in terms of gold and silver, which is really the area to focus on, in my opinion, because they've come alive. It's been a long haul waiting for the breakout in gold. It finally happened, you know, in the last month, and it's started to really run. We obviously, um, at the end of last week, going into the weekend, with what was going on with Iran, and the you know that was all pretty much telegraphed. Um, the metals heated up on Friday, had great runs in the morning, and then gave it all up in the afternoon, and came into this week kind of furthering that weakness. And I think it's turned a corner here. So my guess is we're going to see new highs pretty quickly in both gold and silver. Gold already is, you know, much closer to that point. Silver took a bigger hit as it typically does, but I think it's coming back from that. And you know, I continue to say I think gold's going to 3,000 this year. Silver, I think, is going to 60 and maybe 75 this year. That's a huge run. Very short term, I think silver can get up into the mid to high 30s pretty quickly. Gold probably can get up over 2,500 pretty quickly. So I think you got, you know, room to run there for sure. The miners, which have lagged and everybody's frustrated by, have come alive. They, you know, they had a run, and then, you know, again, kind of with the metals Friday, and then early this week have given back some of those gains, but by no means have they gone back all the way or even close. And they are poised, I think, for much higher. So, you know, I think in many cases you're going to be able to double and triple your money in the miners, and small miners probably much more than that. So it's an area that's been a long time coming, and I've been a bull waiting for this for a while, and it would start and stop. Did that start and stop several times? You know, back in 2022, from the spring of 2022 to the fall of 2022, when the equity market bottomed, people should look at what the dollar did in that time. The dollar went straight up during that 6 months when after Russia invaded Ukraine, and we had oil go to 130. All of that took the dollar straight up, and took the miners straight down. So, you know, that was the first real kind of interruption. It was prior to that invasion, they were poised to break out and get going, and that dollar move just killed it. And since then, we've kind of been rebuilding and start to go, and then it stopped, and you know, it's been up and down, and finally, in the last 6 months, you know, and really the last probably 3 or 4 months, you finally got them going, and I think there is so much upside.
Now, when we think about something like gold running from what 24 or something like that, running up to, you said, three.
Three, yep.
What's the catalyst to get us there from here? We've already seen a pretty big leg of this move. Do you think that there are now people trying to pile in and get caught up? Do you think that people are seeing some sort of fundamental shift in the future that will want to rotate them into gold?
Yeah, well, first of all, keep in mind that we had really four tries, a triple top, and then the fourth try it finally broke through. Um, So it was between 17, 1800 and 2100 for, a couple of years there where it tried and tried again and tried again and was always turned back. So that breakout is a big deal. When we got above 2100 with some oomph and kept going and got up to 20, 2450 or wherever it got to, that was a big deal. Once you break above that kind of a top, it what we've seen so far is small. I mean, it really does argue you've got easily a 50% run from there. So that's why I think 3,000. I think my 3,000 could be conservative. Um, so that's one piece. Is just technically it's just broken out. There's a lot more ahead. I think people are kind of we've been so accustomed to it being in a trading range that
Mhm.
$200-300 seems like a lot in gold, but it's not once you break out. It's just because it was in that tight range, and silver's so much farther behind gold, so it has to come through. It's not anywhere near a long-term breakout, but it's rising above various resistance levels, and I think you're going to see, which typically happens in a bull market for the metals, that whatever gold does, silver will outperform by quite a bit. In bear markets, silver outperforms on down, underperforms, or gets hit harder on the downside. When you're in a bull market, silver outperforms on the upside. So it's just a more volatile metal. But yeah, and then fundamentally, you've got, I think, and again, we haven't seen it yet. We've been in this consolidation in the dollar as well as interest rates, but I think we're very close to a rollover in the dollar. And I continue to say when the dollar finally rolls over and heads south, that you're going to see it go from 106 now down to 80 this year. And if we get that kind of a move, that's hugely helpful to the metals.
I see. Quick market update. We're coming in on the close here, and I'm just watching SPX, and it is just bouncing right back and forth. It's almost at break even. It's up 0.02% to
Huh.
less than a point. It is
Yeah.
just pinned right now. Um, when you think about your melt up and global bust thesis, when we first talked about it 2 years ago, you had kind of a clear roadmap in mind. Then we saw new information come out. Obviously, things shifted. Now, when you think about your melt up thesis now, especially with the rate environment looking like it could be a little stickier, to me, that would be pretty heavy headwinds for some parabolic up move in equities. How does that factor into your forecast there?
Yeah, like I said, I do a lot of cross market work, and I just have a hard time squaring that with what I see across many sectors and across many stocks. In the tech sector, and I can't name names, I would love to, because there's some names there that look outstanding, that just tell me that there's big upside ahead. And it's not just semis, it's in other areas. And then in the industrials, I've already talked about what copper looks like, what steel looks like. There's a lot of upside there. The broker dealers is a big tell for me, because if they're going to go up, that means if the stock market's going up, right? You're not going to have a big run in stockbrokers if the market's going south. So those are, for me, indicators of a market that is um, poised for much higher and soon. And I think what I would argue is you've had yes, the consolidation's been more than I expected, but it's you had a 120 basis point drop in rates in a few months' time. It's not unusual to have a counter trend move that has to shake up all those people. And then when I step back and look at non-treasuries, the junk bonds market, HYG, JNK, it looks poised to reverse here. It did come down. It's been hit with interest rates going up, but not that hard. it's actually held up better than other aspects of the bond market, and looks to me like it can reverse here and have a nice run. So that speaks to an economy that's not falling out of bed. That speaks to interest rates that are probably going to go down, not up. And then when I look at, the investment grade, it's been hit along with treasuries. But again, I think it looks like it's getting oversold now and ready for another move. So I think, again, it's easy to extrapolate a move, and that's what most people do is when rates are up, oh, they're going higher. I don't, that's not how I forecast. I mean, I'm looking at indicators that tell me it's more likely that you've had your consolidation, and doesn't mean it's going to turn tomorrow, but I don't think we're heading to new highs on rates. Let's put it that way.
I see. So, is there a discrete catalyst that then precipitates an up move in your view from here? Or do you think it's more of a slow capitulation and then stair step pattern up as just capital's flowing in?
Yeah, if I put everything I see together, what I get is a scenario that basically says the economy still has enough legs. The industrial areas, the non-consumer areas that have lagged for a while, they've been, dealing with trying to get inventories down and, rationalize their production to what demand is out there. I think they're starting to show signs that inventories are in good shape and they're beginning to produce again. So, I think the industrial side of the economy looks like it's going to be pretty good into the summer. It's not, it's not about to fall out of bed. It's actually getting stronger. Um, when I step back, the consumer, I heard Bank of America today talking about, and they seem to have the best window on the consumer of any of the banks. They say their consumer is in great shape. You know, I think Larry Fink at BlackRock just came out saying that money market uh, funds are at 9 trillion, not 6 trillion now. So we hadn't heard that before. We've heard 6 trillion number. So you've got a lot out there. Yes, delinquencies, credit card delinquencies are moving up. I think they're the highest they've been in since maybe 2011, but quite a ways back. Um, and you've got signs out there of things that are troublesome for down the road, but they don't impact spending right now. And I think if I'm right, you're going to be in a sweet spot here where you're going to have an economy that's soft landing at worst. This is the narrative, not my prediction, not my forecast, but soft landing at worst and maybe no landing will be the narrative, combined with interest rates rolling back over, um, dollar rolling over, inflation going back, trending downward again. All those things are again on the come. I can't point to a number now that says that's the case, but that's what I see in trying to interpret the tea leaves of what the markets are telling me. And then from a standpoint of how it feeds into the market, what I think you're going to see here pretty soon, if I'm right that this correction's run its course and we're about to turn up, I think a lot of those that I said had no conviction. They were bulls, but they had no conviction. And as soon as the market turned tail, they did too. And they've been calling for 10% down, 15% down. I think that's wishful thinking. These are people who missed the whole move, by and large, missed the move from 3,500 up to now. May have jumped in a little bit here and there, but have and once we went to new highs, became more bullish, but said, I'm not chasing this thing here. It's overbought. It's way, it needs to correct. And they've been sitting saying, like I said, it's wishful thinking, but their entry point in their mind is 10% down, and at least. And if they see an S&P that gave them less than 4% down and then turned around, I don't think they're going to wait very long. I think, once this thing gets back up over 5,200, I think you're going to see investors say, we can't risk this again. We can't miss this again. We got to jump in. And I've talked about this in letters and maybe with you, I think we have the potential for what I would call a buying stampede. And I would define that as all this money on the sidelines or money that's in defensive areas becoming more offensive, becoming more, buying those groups I'm talking about and saying, I got to get invested. And all of them try to do it in a fairly short 2 or 3 month time horizon, all coming in at the same time because they all kind of missed this thing together and then waited for a bigger correction that didn't come and now are capitulating and saying, I got to get in. And if they all kind of jump in a fairly concentrated period of time, I think you could find the market's pretty illiquid, meaning on the way down, it was illiquid where everybody wanted to sell and there weren't a lot of buyers. On the way up, everybody's trying to buy and there aren't a lot of sellers. And what gives then is price. And that's how I think you can get, an S&P that goes from 5,000 to 7,000 in a matter of months.
Interesting. Now, if you were to assign a confidence interval on the probability of that thesis playing out as you outlined, let's say in the next few months, as you're kind of thinking about, how confident are you as of right now with what you know now that it'll play out in that frame?
Yeah, I never put a number on it, but what I have said is this is a high conviction call. It's
Gotcha.
not high conviction that it's going to happen between now and June or between now and July. It's high conviction that it's going to happen in a concentrated period, whether that is three
I see.
months, 6 months, but to go 40 or 50%, yes, and the Russell, I'm actually from where it is now is more than 60% to my target. To have that all happen in less than 6 months is unheard of. So that's my conviction. I can't pretend to know which month we top out, but my conviction is the next several months, and it could very well be that it's mostly done by the middle of the year, or it may be that it's not done until September, October. I don't know, but my conviction is that we are in for the steepest rally in history, or one certainly steepest, broadest rally in history. Nasdaq might have been steeper in 2000, 99, 2000, but this will come pretty close to that.
Market just closed. It landed down slightly, down almost a quarter point. So not too bad. Yeah. Couple other questions for you real quick. One of them is one of the parts of your thesis I'm always interested to learn a little bit more about is the bust portion. And the things there that I'm always fascinated by and what I try to draw the listeners' attention to. I know a lot of people, they cling on to the numbers that you say because they're big numbers, right? Obviously, somebody would latch on to that. But what I try to direct people to is to use your term, the reading the tea leaves. I try to pull out the way that you think about and construct a narrative based on your breadth of experience. Because guess what? The only way you get 50 years in Wall Street is by being in Wall Street for 50 years. You can't accelerate that time frame. I spent a lot of time in markets, but I've been in them for 16 years, less than half of what you've seen. So it is really interesting to me to tap into the way that you connect concepts together. So leading into the bust, what are the catalysts in your view after we go through this melt up phase, which could take however long it takes, but the thesis being it'll be a condensed period when it does start? What then rolls us over into the bust? Because one of the things we talked about previously was kind of the global economy. And right now, at least as far as I could tell, emerging countries don't look great, let's be clear. But some of the other just global powerhouses seem to be doing okay here. So I'd like to know if that part of your thesis has adjusted at all, but more importantly, what are the primary catalysts once we get to this blow off top that rolls us over?
Yeah, first, in terms of the other countries, what I'd say is I'm not sure it's all that different from here, and from the standpoint of there's a lot of fragility underneath the surface. The countries, I'll just look at Europe as an example. It's been really amazing to see that 2 years ago, you know, they didn't know where their energy was going to come from. There was all kinds of horror stories about what that winter was going to look like after,
Right.
after Ukraine was invaded. And, they fortunately had enough stockpiled. They got through that one. And then the story was next winter they were going to have problems. And, you know, the costs involved for them to purchase energy elsewhere on the market when they lost, the pipeline from Russia, from Ukraine was, it's amazing to me that they were able to kind of soldier their way through that and stay above water. Not they treaded water, but they stayed above water. Um, Listening to Lagarde today, she contrasted the U.S. and Europe from the standpoint of saying, yeah, we're hanging in there, but the difference is the U.S. has a resilient consumer who spends. We don't have that. She said our consumption is not showing those trends. So I would take issue with those saying that
I
the
see.
rest of the world is in pretty good shape. I think they're they're in worse shape than us, but they're kind of doing what we are, which is kind of muddling through. And you think that maybe this is the worst of it and they can turn up from here. My concern is that's not the case. That this is the good side, and then we turn down from here. And I would say the same thing in Canada. Again, this is anecdotal, but I see it on Twitter and many videos and stuff of lots of people up north saying, I can't afford to live here anymore. I don't know where to run to, but Trudeau's made such a mess of this economy. I'm dying up here. It's the stories we hear here in the US from a lot of young people saying, I can't, I can't afford to live on my own. I have to go back home. You're seeing that in Canada times three. So I think Canada's not in great shape. Their policies are, I think, doing harm to their consumer too. Australia, I think, is some of that. China, we know, is in trouble. Japan is, I keep calling Japan the wild card. I mean, there is something there that you just can't print money ad infinitum like they have and not run into a situation and have zero rates, and basically own all their bonds. The central bank own their bonds and not have that go the other way at some point and really cause what we saw on steroids. In other words, if once their rates break out, they're in a quandary. And besides that, the yen's breaking. The yen keeps going lower, and so I actually, and this is not a prediction, but I wonder if we're getting close to some sort of a currency accord, like the Plaza Accord in 1985, where you actually coordinate a devaluation of the dollar versus these other currencies, triggered by the yen, basically saying, both the euro and the yen are having trouble, or struggling to, not go down. And maybe we need to do this, and it certainly wouldn't hurt the U.S. to have the dollar weaker. So I would not be surprised if that may be some of what the metals market is sniffing out. But again, I'm not predicting that because it's, it may not happen, but I think it's potential out there. Um, I do think that to get to the bust, it still could be triggered by a financial problem, particularly in Europe, but overseas somewhere. Um, but my shorthand for the bust, how we get there, it's or how I why I call for a bust, is that we have this massive leverage like we've never had before in the overall world system, meaning 320 trillion in global debt. And I realize a lot of this sovereign debt, and that's not going to go belly up, but we got 320 trillion debt. That's a that's leverage that you don't want to have going into a weak economy. And then on top of that, you've got quadrillions in notional value of derivatives, which is massive leverage on markets. And it just means whenever the shit hits the fan, it's gonna, it's gonna exacerbate whatever happens in a big way. So, we're so far beyond the leverage we had in 2008-9, and that's why 2008-9 happened, was because of massive leverage. We're so far beyond those levels now that I think the next downturn, when it happens, just go straight down, and particularly the financial system. And we've got a combination of all that leverage and the risks combined with central banks that are hell bent not to make the same mistakes. So they're telling us, Powell's telling us, Lagarde's telling us, we don't want to pump up the system again. We're not going to do that again. We're not going to do QE times 4 again. Well, if you have a system that's imploding, that's the only thing you can do. And if they're going to drag their feet, they will ultimately come to the conclusion they don't have a choice. But that time spent where they have their mind in the wrong direction, that slows down the reaction, the response, it's in that window of time when they're kind of fighting the last war, when they should be saying, oh, we don't have a choice, we got to print money like crazy. Because it just happened in 2020 when they printed 5 trillion, they meaning the Fed, because that was so recent, and because of all the criticism the Fed has received for what's happened since 2008-9, and pumping, QE to infinity, all that stuff, because that's fresh in their minds, and they're convinced that they can't do that again. That just causes them to miss the window, to not respond quickly, and it's during that vacuum that things can fall apart, and then they'll come in. I mean, they will react. It's just they'll react slowly.
Yeah, a matter of how late and how much damage is done. I was pulling up from S&P Global the current relative leverage of risk, and it looks like it's 349 times for non-financials and the financial sector combined, which is just
that's an interesting number. I've never seen that, but that's really what it is. It's
massive.
Leverage combined with a slow response, and ultimately a huge policy error in terms of that delay. You put that together, and something gives in a hurry. And again, it's not something you can time precisely. All I can say is a melt up comes first. And again, global bust is really referring to the financial system and the economy. But accompanying that, in my opinion, is an 80% bear market. So, they go hand in hand, basically.
Yeah. I know that we're a little bit over, so I do appreciate you diving into that last part, though, because I always like understanding a little bit more, peek behind the curtain on the bust side of things, because, I mean, let's be honest, people, whether or not it happens to that degree, whether it happens in whatever time frame, the theory and the way that you're thinking about the problem set is still fascinating. And there's a lot of interesting points you raise out. And again, like, as soon as you start seeing stuff like 349 times leverage, that's terrifying. And you think that, exactly to your point, that is the kind of thing that can get out of hand pretty quickly. The only thing I can say as I look at this chart that looks okay is that in June of 2020, it was at 352 times, and now we're at 349. Drop 3 points. That's pretty good. We're safe now, right? Safe?
Yeah, right. Interestingly, I mean, you saw how fast 2020 happened. I mean, in 3 weeks' time, the S&P lost 35%. It went from seemingly okay, and 3 weeks later, you were down 35%. It just shows you we live in a world today where the speed is just can be pretty amazing, and that's what I think. Ultimately, when it finally hits, it can hit fast, But I would also say people need to remember, because this is the hardest part about all of this as an investor, is the return that can come here. Like I said, the Russell called for more than 60% to my target. And the S&P 40%, or close to 40, and NASDAQ probably more than that. So the returns that we can get here are returns you would get over several years normally that could come in 3 to 6 months time frame. And I have people that know my whole scenario and are really worried about the other side of this, and they're scared to death to be in there. And I go, just know yourself, because these are returns. Yes, the time frame is that we could be in a bust by the end of this year for all I know, but the time frame is different than the magnitude of the return. The returns are 3 and 4 years worth of returns that may come in a very short window. And if you are out now because you're worried about what's coming after that, and then the story becomes so compelling at the top, as it will be, that you jump back in saying, well, I guess he was wrong, there's no bust coming, you're getting in right as you're about to get hit. So it's like, just know yourself. Everybody has to decide for themselves how they manage that scenario, assuming it's even right. But just know how psychology works, and know that anticipating the downside today for most people is not going to do you any good, because you're going to get swept into this thing before it's over. It's so easy to get caught up, because the story at the top will be, this is just getting started. This is a new cycle. This is a new cycle. Steel just got started 6 months ago, and copper just got started, and these things have a long runway ahead. And you're going to sit there and go, well, it sure looks like it. Look what they've just done. And you get back in, and then find out, that light at the end of the tunnel is a train coming the other way.
That part always just I just get such a kick out of how repeatable the mistakes retail investors and traders make. Obviously, I chuckle as you say that, because it's just story as old as time itself. It's not even like mistiming one side of the trade. It's the ability to mistime both sides almost perfectly. I get such a kick out of the way that most traders think about that stuff. So it's a good
think
point.
About it, it's not even just in the stock market. Think about people have construction firms. It happens cycle after cycle. They swear to themselves they're not going to get caught with inventory again. They're not going to build on spec, or they're not going to have land, or that. And then what happens? Now it's the national builders. But what happens is things are so strong, and it looks like it's going to go on for a long time, and there they are again, caught in the downturn. So again, leverage.
Leverage giveth, leverage taketh. But
Sure.
Yeah, David, really, really fun connecting with you. Thanks for hanging out for a little while. If there's somewhere that you want people to reach out to you, where would that be?
Sure. I'm on Twitter every day, so at Dave H. Contrarian. I don't know if we have taken care of some of the duplicate account problems anymore, the fake accounts, because Twitter took it upon themselves to give me a blue check mark, and they did that to a lot of people, I guess, that have decent followings. And I don't know if that really eliminates that problem or not, but hopefully it does. I haven't seen so much of that lately.
Yeah, I'll give the right link anyways. I'll throw that in the notes below.
Okay, so I'm there, and then I have a quarterly letter for those that want to subscribe. It's by subscription, so there's a cost to it. If they want information, they can direct message me on Twitter, and I'll give them details.
Yeah, perfect. Well, David, thank you so much. Absolute blast hanging out, and we will see what happens between the next quarter that we connect. I can only imagine it will be smooth sailing. Everything will play out exactly as we think, and then it'll just be a recap. Great chatting with you, David.
Enjoy the spring. We'll see you this summer.
Thank you so much.